Hello and welcome back to the Maverick Life. It's a deep dive on a stock for the ROI channel, the aspect of this particular channel that's dedicated to the art and science of return on investment. So let's get into it. Disclaimer, guys, I'm not an advisor. This is not advice. This is just me documenting what I'm doing. I've been doing it for nearly 3 years now, 2 years now, and today is a perfect example as to why I like to do it because we can go back and look at what I thought years ago and see how my theses played out. So don't listen to what I say. It's not advice. It's just a crazy guy sharing what he does. So on October the 11th in 2021, I put out a video explaining my thesis on Scorpio tankers and the tanker market and offshore market in general for oil and oil services. I said that I thought the thing was based at an asset value at around about $35 a share, suggesting price to book of around half. It was trading just less than $18 at the time. I thought that we could get to, with everything that was happening in the dynamics, you can go and watch the video. I'm not going to redo it now. I thought the thing could get to maybe 1.5 times its book over the next year or two. So in other words, maybe 200% on the upside. If we fast forward to today, so there's October 2021 down the left-hand side, we've gone from around 1760 to $64.70 at the latest close. Okay, so sitting on about a three bagger if you had got in and held. The question today is, has the horse already bolted or is there still more value in the place? I'm going to do a deep dive. I think it's just handy to look at where we've come from, look at the thesis, if anything has or has not really changed about the thesis, and where could we go over the next 2 years, 3 years. So let's take a look. Only a few things I wanted to bring up from the old presentation, which are the valuations. So at the time, Scorpio was trading at around about 10.5 times EV to EBITDA. So I want you to remember that. It's going to be important later on. Price to book 0.5. I thought they could get to a multiple expansion of, well, at least 1 times book, if not 1.5 times. So we're going to look at it today and say, what's the asset value of this thing now and in maybe 1 to 2 years? And if we could get to 1.5 times that, or did we get to 1.5 times that? And if we did, how's the goalpost keeping on moving? How's that evolving? So book value is share as of the analyst expectations, at least end of this year is expected to be around about $59. I know book value is not the best value to use, but it's quick and simple for a YouTube video. 65 at the end of 2025. So can we say, quick math, obviously can't rely on this alone, but that would suggest 1.5 times book, you might get $90. It might be a $90 stock by the end of 2025, using that very basic methodology. That's enough just for me to keep digging. Okay, obviously I can't make an investment decision based off that. I'd need to do a little more. But let's take a deep dive. Scorpio, it is in the eToro portfolio. Rehash the disclaimer. Nothing I say is advice. So you're on your own. I would, however, advise you to follow and like and subscribe to the YouTube channel. I'd appreciate that. Greatly helps out with the algorithm. You can catch me on Twitter at the Mav Life, and you can check out the publicly available portfolio on eToro. So that's that. Brief overview. If you're watching this channel for the first time, you don't know what Scorpio is or does. They own product tankers. Okay, these things here, they take product, clean petroleum products from the refinery. So once the crude's already gone through, been refined, on the tanker she goes, to storage, onto the tanker truck, to, if you're in Australia, BP or Shell or whoever, fill up your car. If you're in the US, or I don't know, Pemex or Petrobras down in Brazil, wherever, you fill up your car. That's the go here. Crude, they don't have any dirty tankers. They're all clean. You can't mix them up. You got to have a special code on the inside of the tank to carry the product. So your diesels, your jet fuels, your gasoline, etc. That's these guys. That's what they do. They have 101 vessels that take care of this sort of stuff. Average age of 8 years. Why is that important? Because they're the youngest average age fleet. They are, I don't think they're the largest, but they've got maybe the second largest fleet, definitely the youngest, most efficient. So their costs are lower, and they have less capex to spend to maintain their fleet over the life cycle of their fleet. Because once these things get to debatably around 22 years of age, you either look to scrap them or their usefulness really, really drops. Okay, think of it that way. That's going to be important because it still is the backbone of my tanker thesis. And here's the sector thesis. This year, we had 11% of the fleet being ordered, which is the most in quite some time. So do we start to worry about that? That's the question. We know the fleet's shrinking and due to shrink due to the aging factor that I mentioned in 2021. Time's only marched on since then. That's barely going to counteract the number of vessels that turn 15 years of age as of next year. And as of the middle of 2025, half the damn fleet is going to be 15 years of age. So the question is, can the world offset that decay from 2025 to 2030, where you're starting to get it half the fleet at the point that it is 20 years of age? Because once you're 20 years of age, you're going to the retirement home for the product tankers. Okay, there's not a lot of work left for you, and we then as consumers think, well, hang on a minute, how are we going to get our product to our gas station so I can fill up my car? That's going to be an issue. So that's where these guys are going to be super valuable. They've got the fleet. It's a younger fleet, and they're going to be not the only game in town. There'll be other companies with other tankers, but the option for contracts are severely going to diminish, and that means day rates go up. So it's the old supply down, price up, and who's going to benefit the most from that? These guys have the most talk to the spot market, as I understand. So if the day rates start to do what they've been doing recently, these guys are going to be the ones to benefit. More so, I mean, everyone will benefit, but more so than some of the others. New build rate 25 a day. That's where it starts to make sense from an internal rate of return for companies to start investing in expanding their fleet. Okay, what haven't I said here? So if you assume average scrubbing age 22, 24 years, you're really looking at, I think we're going to see the net reduction scenario out to 2026. You're going to have almost negative 3.8% of the fleet growth. So the fleet's going to be contracting, and the demand for the fleet services is going to increase 4.3% over the next 2, 3, if not 4 years. And here's some data from Clarkson's that supports that kind of thesis. So you do have new builds coming online, but then you're looking at the age of the tankers and starting to wonder, yeah, but they're not going to be pulling weight like they used to, literally. Okay. And that seems to be tapped out the further out we go. Strong demand. We've got refinery capacity increasing, particularly in the east. And I guess the other thing to mention here is a right tail event. If things continue to deteriorate around the world, but particularly in the Red Sea and the Suez Canal, you're going to have charter rates go through the roof, in addition to which the time in voyage to the TCE is going to increase. And another interesting point is these guys are going to have to put their foot down more and churn out more oil or more product to be able to reduce the transit times as much as they reasonably can. So you presume that's bullish for oil consumption. Here's refinery product. We won't go into it in too much depth, but I guess suffice it to say that the amount of clean petroleum product out there on the water is at 19.4 million barrels a day being moved around, and that's back up to pre-COVID levels. Like it's surpassed pre-COVID levels, and that's important. It suggests that we're finally getting back to this expected land of aviation activity, truck and transit activity, getting back to where we were before the whole world went crazy during COVID. I guess that's probably the best way to look at it. Up to the right, US looks like it's having a bit of a diesel issue. Doesn't have a lot of diesel around, but at least according to that graph. So diesel is a refined product. They're going to want to improve that situation, I would imagine. And so refinery throughput should be starting to max out. I would expect more work for Scorpio. They say, hey guys, we've got all this diesel. We need somewhere to put it and take it to the US in this case, wherever around the world. The Aussies down here dominating as we always do. Just kidding. looking at around about almost 1.1 million barrels a day refinery impact. Goodness gracious, capacity is capacity. We could be investing a little bit more on the refinery capacity. Let's just leave it at that. Anyway, time to move on. Management. When you talk shipping, you got to look at management. Okay, these guys are one of the decent actors in the sector. How do we know that? Well, we can take a look at the share count. The share count's coming down as opposed to going up. Debt is going down as opposed to going up. And the fleet, they have taken a couple of new builds. But the point is, they're not taking their newfound increases in earnings, abusing the shareholders by writing out or diluting more shares in order to buy more ships and doing the whole sort of spin-off company Greek thing that they do. These guys have paid down 1.3 billion in debt, over $500 million in share repurchases. That makes the most sense for now because they're trading at a discount to their asset value. So why would you give out a dividend? You know, to some degree, why would you pay back debt when, as you saw in the Valaris video, you can buy back your own stock? The thing's trading at, let's call it, I don't know, 18, 20% of its replacement value. No one else can build new fleets in time. It just makes more sense to do that for now. The plan is they'll continue to do that, pay down debt, buy back shares until the price and value gap closes. And then they've got to revisit. They've got to say, okay, well, does it make sense to buy back shares? Or should we start to take over another company that's trading at a discount? Should we just dish it out to the shareholders as divvies? Do we have some really good contracts that would give us confidence to expand the fleet then, and only then would we start to, what would I, if I were the sort of CFO, CEO running this thing, start to look at doing that? Okay, they've done a good job. They've done exactly what they were supposed to do. Shore up the balance sheet, make the company more robust, and it's trading, under 1.5 times net debt to EBITDA. That's okay. Global trade routes, and just want to point out here, going through the Arabian Gulf, Red Sea, Strait of Hormuz, and I forget how to pronounce the Arabic name, where our friends the Houthis are in Yemen, taking pot shots at various container ships from the shore. These things, if you can't go through this line where my cursor's pointing, you got to go all the way around the Cape of Good Hope, I believe, down the south of Africa anyway, and come up into European ports. So you add at least 33 days from what I've read to each journey. That's going to cost you more money if you're chartering a tanker. What costs you more money, in this case, the tanker company, Scorpio, makes more money. That's about as simple as I can put it. All sorts of potential for disruptions on that particular chart. So price to book value, do you remember I said in 2021, I was expecting to get to maybe 1.5 times book value? Well, we're pretty close if you look over the rearview mirror for the last 12 months. And so if I look out today and I say in 24 or 25, what's the book value going to be? Can I get 1.5 times that? Why not? Why not? I don't see why not. And previous multiples on this thing, you've had a 10 times EV to EBITDA, which you saw in 2021. Normalized earnings 9.6. Why can't that get to 10? I think they could easily get to 10. But we'll see today, the market is only putting a value, basically half of those valuations. So I'm going to do an earnings valuation in a moment. Before we look at the earnings, what's the earning potential for these guys that have got, quote unquote, I guess, naked exposure to a rising spot market? If we have things go crazy like they did in Q4 of 2022, I understand the fleet status is a bit different to then, but this was when you had the whole Ukraine-Russia thing making headlines. Nothing has changed. There's still a horrible war going on there, and we've got even more geopolitical risk. So why can't we get back to 40, 45,000 a day rate? And I don't see any reason. If you were to model a 40,000 average TCE rate for this particular company, cash flows, according to management at least, are expected to be around $17.5 a share. Okay. So if things just sort of stay around where they are now, $30,000 day rates, multiplying that by the vessels that can do that, you're looking at roughly $10 a share. So $10 a share, and 10 times earnings, you're looking around about $100. Is that unreasonable? I don't think so. I don't know if they'll get there in 24, but in 25, certainly, if you have 2 years of this under your belt, at a $60 stock price, this thing could do close to 2/3 of its entire market cap in free cash flow in 2 years. If rates are staying around about, between the $30,000 and $40,000 mark, that could certainly happen. All right, the world famous, very rough back of the envelope calculation. What do I think this thing can do in EBITDA and free cash flow? And if I look at its peers, so this is a summary of all the main players in the sector and the multiples the market is currently applying to them. So here we're going to use the median. Okay, so we're just going to use the median for these. Arguably, you should use a premium because this has the youngest and probably best fleet. But anyway, median for EBITDA, median for free cash, there or thereabouts. My estimates, I think you could be looking at these numbers on an EBITDA free cash flow per share, whack a multiple on it, equally weighted average, you come up with around about $93 as a very crude valuation metric. So potential for $93 by the end of 24, certainly 2025. I mean, if they're doing, say, 2 years of $13 a share, that's $26 a share of free cash flow. The thing will be trading at a 33% free cash flow yield. It's done nearly a third of its market value in 2 years in that case. And if you go to the upper scenario of maybe $17, $18 per share of free cash flow with day rates, you remember at 40,000 for that to happen, then $36 of free cash flow, the thing's trading at 50% free cash flow yield today. It doesn't make sense for it to get to $5. You'd have to be closer to $150 a share. Remember, the company's going to take that free cash, keep buying back its own shares until it gets closer to this $90 value. We'll see. Interesting. If you were to use an 8x for EBITDA and a 10x for free cash flow, we come to around about $139 a share, just using quick math. I mean, it does pass the sniff test. The valuation, so from an asset valuation perspective, what is it going to cost me? If I wanted to rebuild this company today, how much would I be up for? So here's the vessels that they have. These types of vessels, what each vessel is roughly going to cost to build today, and the number of vessels of each respective vessel that they have. If you tally all that up, we get to $5.3 billion on an enterprise value of about 4.5, a market cap of just over $3 billion. So definitely trading at a discount to new build. But there was a gentleman, Monish perhaps, I forget his name, but he put a question on the Valaris valuation method and said, yeah, but why don't you depreciate it at 2.2% per year that the particular offshore vessel in that case has? In this case, it'd be tankers. You certainly can do that. It's a fair point. You can apply whatever discount rates or depreciation rates really work differently in terms of aging with offshore vessels. It's a different game, different capex requirements, different replacement requirements. And my friend Tommy Deepwater would argue that it's not the same thing. It's not appropriate to use in that scenario. Either way, for tankers it probably is. So I'm going to do it here for you and save you the work. Depreciated at 2.2% per year. Here's the implied value using the average age of their vessels for each vessel type. Cut a long story short, you're looking at an implied value still of about $4 billion. So the whole company, enterprise value today, if you had $4.5 billion, you could buy the thing at its replacement value, taking into account depreciation. So its implied value is what I call it. I don't know if that's the right word or not, but I'm sure you follow me. So we're looking pretty good. You're not overpaying for the steel. You're not getting it at a massive, massive, massive discount like you were, or are you? I think you're still getting it at a 20-30% discount. I think that the asset value is around $90, $100 today. So you know, 2/3 value. It's not as cheap as where we were, but it's got a lot less debt and it's got a lot more a lot more near-term exposure to potentially exploding day rates. So the guys in charge, do they have skin in the game? That's the question. So Rob old Bobby Bugby, he's the president. So he's involved. He's got 65 million worth of shares. Then we've got these two gentlemen down here, Cam McKay, I think he's the COO, Brian Lee, and then Eduardo or Emmanuel is the CEO. He's also got about 1.3% of the company. He just doesn't show up on this list because I think it's capped at 10. So he's certainly got skin in the game. He's got nearly $50 million worth at stake. So I say yes, these guys are going to want to see their holdings or the value of their holdings increase. Buybacks. That's all I have to say in that regard. So I'm long the stock in case you hadn't already got that. I'm looking to build around about 5% of the assets under management. May go a little bit more than that. And just depends on what happens. But I think these guys are the ones. I think these guys are the way to play the sector. They got the most exposure to that right tail event. They've got the youngest fleet, discount to net asset value. Not only a strong earnings outlook, but an accelerating earnings outlook. No supply side risk really. Given that the age factor, I think if you're patient enough, this thing, still has several years of legs to run. We're not going to double the fleet overnight anytime soon. And most importantly, when it comes to the maritime sector, they're shareholder friendly. So thank you very much for watching. I hope you appreciate that. Do like, subscribe, and leave a comment. And I look forward to catching up with you in another video shortly. Thanks, guys. Take care.